Your views on markets performance today. We did get a bit of a disconcerting view earlier in the week when we saw the market retreat below 3,500. What's it going to take to really help this market?
Okay, the market today performed similar to what happened yesterday, declining further. I would say that optimism has worn down considering the declines this week and reduced equity turnover. With the reduced equity turnover, we're also seeing reduced foreign activity that's affecting the market.
When we did see the market recover a little bit in the last few sessions, it was really a function of the Kenyan shilling, which continues to show resilience to global forces. Will the shilling continue on this track?
Okay, it's unlikely that the shilling will continue in this track because we're seeing also the exporters selling off the dollars they received in last week. So we expect the shilling to strengthen further. Indicators are showing that resistance could hit about 92.60 by the end of the week.
All right. Obviously, we've seen a very aggressive interest rate hike by the CBK, 400 basis points at the last MPC. It's pushing up the cost of loans. It's pushing up the cost of doing business. What's the broader implication for companies as they head into the fourth quarter of the year?
I would say the banking sector in particular is in distress, considering the effect of the high interest rates on both on the debts, the loans they have given out. This could increase the non-performing loans. In addition to non-performing loans, would expect competitive activity to heighten because now they're competing for funds and the market is actually illiquid. Okay,
is that the reason you'd use to explain the results we're seeing coming out of National Bank of Kenya? I mean, that stock was down 5.8% today. The profit's down over 8% due to higher costs. Is it a lot of provisioning that's coming through from the rising interest rate cycle?
Yes, it's true. If you compare National Bank with its peers in the Kenyan banking sector, well, it's one of the few banks that increased their provisions for impaired loans. Other banks, for instance, Barclays Bank, reduced the loan provisioning, bad loans provisioning, and this was actually one of the reasons why it performed. It returned to profitability.
Okay, many people obviously are looking to the banks as an indication of how healthy the economy is, the propensity to which they're prepared to issue loans, the extent to which they're exposed on the forex side. Obviously, the banks are also holders of a lot of treasury securities, and this is the broad-based vulnerability of banks. Comparatively speaking, how will banks perform going forward? You did say that they are vulnerable, I acknowledge that, but we've seen some of the bigger banks, the KCBs, the equities, showing a significant resistance nonetheless.
Yes, KCB and Equity Bank have shown some resilience, but there are also banks like Standard Chartered and Barclays Bank that are fairly conservative with regards to lending. And this could affect the performance going into the fourth quarter. One thing that could affect the performance of banks is likely to affect the performance of banks is the high inflationary pressures. Considering the operating expenses continue to increase while the interest income in particular declines further.